Hello and welcome to EverThrive's Market Update. I'm founder Valerie Leonard, and today we're going to jump right into talking about what investors need to know for the month of April. But before we do, just know that this video is being recorded on Tuesday, April 8th. Today, we're going to take a look at Trump's tariff policy and strategy and how the market has reacted since last Wednesday's announcement. We're also going to look at what you should consider when you think about your own money in light of the recent downturn and how having just a little bit of perspective can help you navigate all of the volatility that we're seeing. As I mentioned in my March video, it appeared that there would be turbulence ahead. And unfortunately, that is exactly what we've seen. So to set the stage basically for this month's video, I want to start by taking a very brief walk down memory lane by helping you understand a little history of tariffs here in the United States. So currently, the United States, of course, is embracing tariff policies from over 100 years ago, which is when we had one of the highest average tariff rates on manufactured imports in the world. So from 1790 to 1860, average tariffs increased anywhere from 10% to 60% over that time period. And they were the greatest source of revenue for the federal government until basically the income tax system was launched around the year 1913. So at that time, tariffs actually accounted for as much as 95% of federal revenue. So we certainly can't say that tariffs are a new tool in our country's tool belt. But where are we today? So Wednesday, Trump announced reciprocal tariffs on countries throughout the world, ranging anywhere from 10 to 50%. So 10% on all trading partners, and then additional rates based off of every country out there. So according to one recent analysis, if you consider 45 of our country's largest trading partners and you weight their tariff rates based off of how much we're importing from each one of those respective nations, it appears that the weighted average tariff rate may be sitting near 30%. But we've also seen estimates that have indicated that the weighted average may actually be much lower. Regardless, China announced retaliatory tariffs on the United States, and then other countries are expected to react as well. Now, the White House has said that more than 50 countries are interested in tariff talks, and it just isn't clear at this point what the outcome will be of any discussion. So stay tuned for more details on that front. But when trying to figure out the effect that tariffs will actually have on our economy, we've got to recognize that no one really knows. FedEx just recently did a survey. I thought this was really interesting. And they found that 88% of small businesses say that they have some or a very high level of dependency on imports. So what does this mean? This means that each company is going to have to decide how much of the tariff cost they want to absorb versus how much they want to pass on to consumers. And to be frank, President Trump's tariff strategy does come with a potential fundamental problem, and that is we can't have our cake and eat it too. So what does that mean? The United States may be able to generate revenue from tariffs. That is a possibility. But that's only the case as long as imports don't decrease. If business and consumer demand start to decline, imports are likely to decrease. And then we would see in that case, tariff revenue would come down as well. So Trump's shock and awe approach to tariffs may be designed to generate more short-term revenue while also potentially lowering interest rates for both consumers and the U.S. government as the economy slows. That's what we've seen over the last few days. So given the fact that overall fear levels have risen this week, the bond market basically took interest rates lower, and the Federal Reserve is likely to follow suit. And don't forget, as I mentioned in last month's video, both Trump and Treasury Secretary Scott Bessent have cautioned about short-term pain over the next 6 to 12 months. Also, the Trump administration appears to be sending mixed signals on trade. So many people believe that his ultimate goal is to boost American manufacturing and improve trade terms, but his immediate focus right now seems to be on budget and tax reform. Once budget and tax legislation are potentially finalized within the next few months, he then can turn his attention and pivot to negotiating tariff agreements aimed at securing trade, economic, and obviously investment terms for the United States. And keep in mind that if tax cuts are passed or interest rates decline, These changes may stand to stimulate spending. They can help to offset tariff costs for U.S. consumers and possibly counterbalance slower economic growth. Third, this month, I want to talk about the market reaction. It's no secret how the market has reacted. We've seen slow declines in the overall market since February 19th, which was the peak in the S&P 500, as you can see on this chart. And that continued through the month of March. And then we saw steep declines last week with increased volatility since the April 2nd announcement. Now, last Friday, we actually saw the largest trading volume in stock market history. Okay, so lots and lots of people were making changes last week. And as you can see on this chart, it really looks like a hot knife through butter type look. So to give you some perspective, the S&P 500, just so you know, was down 13.93% as of yesterday's market close, but it's down nearly 18% since the February 19th peak. And much of this downside has been driven by the Magnificent Seven, or maybe not so magnificent seven companies that I've been warning about in my videos over the past year. And as you know, markets and investors like certainty. So it's natural that markets will react to uncertainty. The news headlines we are seeing right now about a potential recession and possibly lower first quarter GDP are amplifying people's fear, and fear causes people to overreact. Another factor that is leading to higher market volatility is what we call liquidity risk. So when market and economic risks rise, many funds or financial institutions are forced to sell some of their positions even when they don't want to. And they're doing that so that they can de-risk and raise liquidity. We're seeing a lot of that happen right now. So because of these factors, investor reaction this month is exactly as expected and completely unsurprising. The fact of the matter, though, is that market valuations have come down to much more reasonable places. And while I still think there's a high probability of further downside to come, I'm grateful that the sell-off has come rapidly as opposed to taking months or even years to correct, like we saw after the dot-com boom and subsequent bust. So let's talk about behavioral finance, which is especially important to consider right now. I study human behavior a lot, especially in light of financial decisions. And I enjoy learning why people behave the way they do. In probably half of our market update videos, we've shared charts about how devastating it is to a portfolio to miss the best days in the market. So to give you an example here, JP Morgan found that missing just the 10 best days in the market over a 20-year period can slash your returns by 50%. So that is definitely a case for not overreacting when the market sells off. So it's important to consider some common behaviors which can cause people to sell too quickly and also miss out on quick market recoveries. First, the biggest reason people make emotional decisions when investing is due to their fear of losing money or panic selling. When the market dips, it's natural to feel scared. We are human beings, okay? That is natural. And watching your 401k or your investment account balance drop can make you panic. It can make you want to cut your losses. And many people believe that pulling their money out of the market during a downturn will help them avoid further losses. But in reality, this fear can also lead to missing the market's recovery. The second thing to consider here is, as human beings, our desire for control, which we also call action bias, leads us to making emotional choices when investing. We like to feel in control of our money, right? And when the market is volatile, many people think that they should do something just to fix the situation, like pulling money out or waiting for the market to recover before investing again. And this action bias, which is the desire to act when things feel uncertain, leads people to believe that they can outsmart the market, which is not true. Third, optimism bias or overconfidence can lead to poor investment choices as well. Some people believe that they can predict the market. With the headlines that we're seeing and market predictions constantly circulating, it's easy to think, I can see the signs. I'm going to pull out now. I'll jump back in when things look better. But this overconfidence makes people believe that they can time the market perfectly, even though market movements are notoriously hard to predict. We can't time the market right every time. Even if you get lucky and time it right once, chances are you're not going to get lucky a second time. So you got to know when to get out. You got to know when to get in order to time the market. And none of us know that. Fourth, often we can have a fear of missing out. The fear of regret can be a powerful motivator. And when people see the market going down, they fear they'll regret not pulling out of their investments. And in this case, they're focusing on short-term losses and they're failing to see the long-term opportunities that come with the consistent investing. And last, let's talk about the herd mentality or following the crowd. This is something I'd certainly like to caution you against today. When others are pulling out of the market, it's easy to follow suit. When your friends, your family, your colleagues are selling off, they're stopping their contributions to their retirement accounts, it can feel like the safe thing to do. Okay. But this herd mentality reinforces the belief that timing the market is smart, even though long term data shows otherwise. So, understanding these emotions can help you recognize why it's so tempting to believe in timing the market. But the truth is that trying to time it often leads to missing out on the best gains. So stay calm, stay consistent, and remember that long-term growth often beats short-term reactions. Also, don't forget, if you're contributing to your retirement plan at work, you should think twice before discontinuing your contributions. A lot of people get their statement and they're like, what's the point of me contributing? My account was down more than I contributed last month. But if you stop saving money into your company's plan, you could miss out on the potential for tax savings this year and your company's matching contribution if they offer one. Not to mention, you can buy stocks when they're potentially on sale when the market's down. Lastly, the most important piece of guidance I can give investors is this: calm and patience should be your highest priorities. If you're a client here at EverThrive and we're managing your personal investments, you know that your investment portfolio is carefully crafted with your personal risk tolerance and your goals in mind. And as a general rule, I don't recommend adjusting your risk level or making big changes to your investment strategy in the middle of volatility like this. Legendary investor Peter Lynch is famous for saying, far more money has been lost by investors who are preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. And I have found that to be true throughout my entire career. So in short, my advice to everyone watching today is to keep calm, carry on, and know that our team here at EverThrive is here for you. Thank you for watching this month and for subscribing to our YouTube channel. We will see you again next month.